I think the single biggest thing I just want to stress, I don't think anybody relishes in the downfall of SVB.
Hey everybody, so I'm here with Basile Senesi and we are talking about Silicon Valley Bank. So Basile, your background, you're the CRO right now at ARC Technologies. Why don't you give us a quick overview of your background and then let's dive into some of the common questions that we're seeing and hopefully we can answer them.
Yeah, for sure. So I'm a tech startup guy and more specifically a fintech startup guy. Been doing this for a long time. We know each other, Kyle, from our days at Intuit. Since then, I was early on the Fundbox team where we built it up to be a large SMB fintech player. And then over the past couple of years, I've been playing an advisory role to a number of early stage fintech startups. Currently, as you mentioned, I'm sitting as CRO at ARC, and we're focused on helping startups get better access to cash management and financing to grow their business.
Cool. Awesome. Well, thanks for that. So can you give us, pretend I'm 5 years old or something. What exactly has happened? I think most people get what a bank run is at a high level, but what is actually going on here?
Yeah, so I think, look, there's two trends, right, that kind of explain the moment. One of them longer term, one of them very much immediate and of the here and now. Traditional banks like SVB have been losing market share to upstarts like ARC, like Mercury, like Brex for some time. Their clients have been expecting a better banking experience. Fintechs have delivered that. And for a variety of reasons, some regulatory, some just due to their sheer organizational size, banks have been slower to deliver. That's again been happening a while. What's happening in the last 48 hours, though, is that trend accelerated meaningfully with massive capital flight away from SVB into a number of different fintechs, ARC included, and of course other banks as well who serve the tech ecosystem. But why did it happen, right? I think there's a couple of underlying reasons that caused this. And if you kind of go back to the order of events, post 2008, bank regulation was amended to create a lot stronger provisions for the protection of depositors. One of those provisions required banks to have a lot more cash on hand to service their deposits. That required banks to invest in a number of different asset types, like bonds, bills, et cetera, to make sure that their balance sheet was shored up well. Well, that was great up until this past year. The environment in which we've been operating means that a lot of those assets have absolutely exploded through interest rate rises. And the decisions made last year when buying treasury bills on 12-month maturities, for example, means that those assets look very different today. Bottom line, SVB made decisions last year around how to build its balance sheet based on these regulatory requirements in a way that no longer made sense in this current market. And they communicated that change in their earnings call earlier this week. I'm not a banking expert, but what I can tell you is this. I think the general story here is that communication wasn't received well, and that their attempts at saying we're changing the composition of our balance sheet to better meet the moment created an initial panic, and SVB's further communications afterwards reinforced that panic by basically saying, don't panic, everything is okay. So it's a little bit of, two things. On the one hand, absolutely mass hysteria that I think is driving some of this, bank run. But more importantly, I think it's the result of just, wrong place, wrong time for a bank like SVB, who's been a huge pioneer in tech banking. They're not quite ready. They weren't quite set up for this moment. And I think, because of their scale and regulatory requirements, we're slow to adapt. Happy to double click into any of that. There's a lot to unpack.
Yeah, I mean, it's fascinating. I mean, it makes a lot of sense. So would you say that you kind of mentioned this, but it sounds like the vast majority of this was a communication issue. Is that fair?
I think there was a real underlying need for them to recompose their balance sheet differently. Right. I just don't think the way in which that was received by the market and the way they communicated to the market was received well.
If you're a company and you have money in Silicon Valley Bank right now and you didn't pull it out when everyone else does, are we done? What happens there?
I don't know. I don't think anybody knows today. I don't think we've really faced many situations like this. Today, the federal government announced that they were effectively stepping in to handle the situation and effectively, force SVB out of business. That means that, as we understand it, FDIC insurance, which is built and designed to protect from this kind of event, should cover any funds that were stuck in SVB and that didn't leave in the last 48 hours. The problem is that insurance probably doesn't cover. In fact, we know doesn't cover much of what was in SVB at the time this all started. Now, here's the thing. 48 hours in this kind of environment is a long time. A lot of money left SVB in the last 48 hours. We know that. We don't know how much. Only SVB knows how much. Only regulators know how much. So I'm hopeful that a good portion found a new home in other places and that it's still going to be available for founders. But I'm equally confident that a lot of that money didn't make it out. And I can only pray, frankly, that much of that is covered to the largest degree possible. If it isn't, I think that's going to spell a serious shock to tech financing and the tech economy, because it's a lot of money being taken out of the system.
Right. And one of the things I've seen is that not only were startups holding money in Silicon Valley Bank, but also VCs were. And I'm then curious, and obviously we don't know everything right now, but I'm just curious, is this a bigger deal for VCs who had significant capital in Silicon Valley Bank, or is this a bigger deal for the startup companies? Of course, outside of them not being able to make payroll and stuff, I just mean like from a financial perspective.
Yeah, I mean, look, I think that the bottom line is, it's been a relatively capital starved market for the last few quarters now. We've been talking about how hard it is for startups to raise money, how the bar has gone up for VC funds to flow to startups who are looking to raise. No matter the outcome here, I think the bottom line is it pulls a lot of money out of the system. Some of that money is money that was likely held by tech companies who may have a hard time recovering it. Again, I'm hopeful that over time that will be mitigated, but in the near term, I think will be very, very tricky. And some of that money was, to your point, likely the funds being held by portfolio managers. Mm-hmm. Again, I'm not an expert on this space, but what I understand is generally, while VCs do hold a good amount of cash to make their investments, they also call on capital from their partners, their limited partners, on a regular basis. And so I don't expect that all of the money that these funds raised was necessarily held in cash at SVB or otherwise, but I do think a chunk of it likely was, and we'll probably see that mean that some of the money available for investment has gone.
Jeez. Well, let me close this out by just trying to summarize. I think the biggest asterisk we have to put on this whole thing is we don't fully know the consequences of all of this. It could be extra super bad. It could just be bad, right? There's a lot of levels here, so we'll see how it plays out. But if I were to summarize essentially what happened, and correct me if I'm wrong on any part of this, sure, is a bank has all of this cash. It needs to do something with the cash. It tries to give out loans. If it doesn't have loans to give out, it usually invests in securities. And then what happens is a year goes by, things really start to dip. And when people start pulling out money from the bank, they go, well, we need to sell some of these securities at a loss. Originally it was unrealized because we hadn't sold anything yet. Now we need to sell these securities at a loss to make up for the deposits. And that happens so quickly because all of these securities are at a loss and they don't have, access to all of this capital. Essentially, they don't have enough money to give people the money that it says, in their banking statement is in their account. Is that correct?
Yeah, I think you're right. I think that's a pretty good summary of the situation.
Awesome. Well, hey, thanks so much for taking the time. I know you're slammed today, and then I might, grab you again as we learn some more stuff.
Let's do it. And Kyle, just one parting shot for your listeners and your followers. I think the single biggest thing I just want to stress, I don't think anybody relishes in the downfall of SVB. I think there's one theme that is very, very clear here. Lots of companies are trying to help. I like to think we're doing a small part in providing that help. But at the end of the day, this is a very, very difficult couple of days for the broader ecosystem. SVB has been a very long-standing pioneer and supporter of tech. And we're not going to forget this anytime soon. This is one we're going to remember, and it's going to hurt. And I genuinely hope for good resolution for the entirety of the sector and for SVB, its team, and the folks there.
Yeah, well, thank you for that, and I'll make sure we have your LinkedIn on this as well, so people can follow you, because you've been doing a lot of good content on this, which is why I wanted to actually reach out to you.
All righty, cool. Well, thanks so much, Basile. I really appreciate it.
You got it. Thanks. Bye.